The traditional trading floor is an environment of sheer chaos, relying on hundreds of traders reacting aggressively to split-second market movements, driven by human impulse. For the individual manual trader, this speed creates a cycle of constant anxiety. You watch a stock climb and feel the pressure to buy in, only to worry that you've entered the trade far too late. Every dip and spike feels personal. A sequence of bad trades creates loss trauma, a psychological state where the pain of losing capital clouds judgment and forces decisions based on fear rather than logic. The human brain cannot process millions of real-time data points simultaneously. Manual trading at this scale functions as a high-stress gamble, lacking the consistency of a repeatable system. Yet there is a way to participate in these exact same markets without touching a screen during active hours. This is the reality of the algorithmic trader. While prices fluctuate wildly, they might be out walking or relaxing with their family. They remain completely detached from sudden market dips or spikes. How can two different investors, putting capital into the exact same volatile market, experience two completely different psychological realities? The difference lies in the architecture of the decision-making. The algorithmic mindset replaces emotional gut healings with strictly defined mathematical instructions. A vague market observation is translated into a rigid binary condition. The market either meets the exact parameters to trigger a trade, or it doesn't. Because every decision is tied to a predefined parameter, the mystery of a losing trade disappears. If a position is exited, the data tells you exactly which rule triggered that exit. Defining these rules in advance allows the trader to step back from the live execution and focus on designing the system itself. Before risking capital, these rules undergo a stress test. You scrub back through years of historical market data, testing how the strategy survives past crashes and rallies. The simulation generates objective key performance indicators, revealing actual performance across different market conditions. A trader uses these KPIs to refine their rules. You can identify exactly where a strategy fails and iterate on the logic without risking a single real dollar. This strict reliance on historical validation replaces blind hope with a concrete confidence based purely on mathematical evidence. The algorithmic mindset does not rely on finding one perfect strategy. Instead, it involves running multiple, diverse strategies simultaneously across various assets. The system automatically allocates budgets across these strategies. It balances aggressive, high-reward opportunities against strict risk limits to create a smoothed portfolio trajectory. This weighting deconstructs risk, ensuring that no single market failure can compromise the entire portfolio. In a real-time market crash, prices begin plummeting. For most, this is the moment of peak panic. The manual trader is often paralyzed. Between execution latency and the emotional weight of the loss, they struggle to make the rational choice to exit. The automated system, however, recognizes the breach of its risk limits and executes its exit strategy instantly. In a crisis, automation enforces the exit strategy without hesitation, bypassing the human panic that usually leads to larger losses. This shift to algorithmic trading is about managing cognitive load. It moves the effort from the moment of execution to the process of design. Once the heavy lifting of testing and optimization is finished, the machine handles the burden of execution autonomously. While the design phase requires focus and diligence, it eventually removes the daily stress of screen watching. The real return is the consistency of the system and the reclamation of your peace of mind.